Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
All right, welcome, listeners, to episode 184 of the Independent Advisors Podcast, where Taylor Ledbetter and I, Aaron Kramer, bring you everything you know from the past week of the world of financial markets and financial planning. So, hey, Taylor, how's it going? Excited to do this. This is going to be a special Secure Act 2.0 podcast. So how do you feel about that?
We have a lot to go over.
That's right. Yes. So for listeners, since this is a really tax-heavy topic with the Secure Act 2.0, I wanted to just provide a little disclosure before we get started. So I'd like to inform viewers and listeners that Jessup Wealth Management does not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisors before engaging any transactions. Okay, so that's our little disclosure before we start. So, Taylor, we have a bunch of information to run through. So I figured we could just kind of switch off and talk about all the different topics that have come out with the Secure Act. So I want to say it was a couple weeks ago, it kind of got slipped in with the omnibus spending bill. It's kind of this 4,000-page document that they snuck in with the spending bill. So there's a lot of really good info. There's a lot of changes. So if you're all right, I'll kick it off with the first topic. And perfect. So the first topic is going to be required minimum distribution. So with the first Secure Act that was in 2019, RMDs began at age 72. So required minimum distribution, or RMD, is when you have to start taking money out of qualified accounts or IRAs. And the Secure Act pushed that back to 72 years old. The Secure Act 2.0, under the new rules, distributions will begin at age 73 if you are turning age 72 in 2023. So age 73 will continue all the way until 2032. And then beginning in 2033, RMDs will be pushed back even a little bit further to age 75. So I think this is probably the biggest impact for the majority of people is RMDs being delayed again. So my guess on why they did this is it's people are living longer, they're having a longer period of distribution. So it's nice that they can continue to delay those, especially if they're still working and things like that. So that's, in my opinion, one of the bigger changes here.
Yeah, and I think over time we'll continue to see that age get pushed back as well.
I agree. So as people, again, continue to live longer, I think it makes sense to give people a chance to let this money stay tax deferred as long as possible for retirement. So it's nice. I'll kick it off with the next one, unless you have anything else on that.
Nope, that was pretty straightforward.
Yeah, that one's one of the more simpler ones here. So
yes.
The next change is going to be Roth related changes. So there is an elimination of required minimum distributions for plan Roth accounts. So essentially what that means, under the current law, Roth IRAs are not subject to RMDs during the owner's lifetime. However, employer-sponsored plans like 401ks, 403bs, governmental 457s are subject to required minimum distributions at age 72. What's nice with the Secure Act 2.0, RMDs for those accounts are not going to continue starting in 2024. So they're eliminating required minimum distributions from Roth employer-sponsored plans or qualified plans, which is nice. So again, it makes sense. What are your thoughts there?
Yeah, I mean, I'm surprised that something like this didn't happen a little bit sooner because, with the regular Roth IRA account, there are no required minimum distributions. But, previously there were for the qualified plan Roth account. So I'm glad that this is one change they did include in this big bill. I think it's a great thing to add in.
Yeah, absolutely. And I think it makes sense given that they eliminated the stretch provision for Roth IRAs for inherited accounts. So again, if you're going to force people that 10-year window to give up that Roth status essentially for a retirement account, if it is Roth money, it makes sense that you would eliminate RMDs anyway. So it's kind of that give and
Yeah,
take, right?
for sure.
That's a good one. All right. What do you have?
Yeah, so kind of sticking with those Roth related changes. Another change in this bill is the creation of simple Roth accounts and SEP Roth IRAs. So previously, simples and SEPs were only allowed for pre-tax funds, but now the Secure Act 2.0 is allowing these accounts for after-tax funds. So it'll take a little bit of time for employers to implement these new Roth accounts because the IRS still has some policies and procedures that they need to put in place. But I think this will be a great addition, especially for smaller businesses who maybe deal with simples, for example.
Yeah, exactly. So in the past, simple IRAs were all pre-tax money. So it's nice to give people the Roth option, and simple plans are great because they're cheap and super easy to set up for the average small business. So I think that's just another incentive for employers to provide a plan like this. And I think that's a really great change that happened. So it's a good
Yeah,
one.
I do too. It's a huge benefit for employees and employers too, I think.
Right.
So just adding on to some more Roth related changes, employers' matching contributions are now also allowed inside Roth accounts. So like a Roth 401k or a Roth 401b, whereas previously employer contributions were pre-tax.
Right.
So,
Yeah, that's really interesting. I'm curious how that's going to work, because if it's after tax money, I wonder if the employer would still get that tax deduction or write-off essentially. I'm guessing they wouldn't, because it is after tax money. So I'd be surprised if a lot of companies are willing to do that. So that's an interesting one. It's a cool benefit, but I think we need to have more clarification on what that looks like for employers before they start doing that, because I think some might be hesitant to do after tax matching.
Yeah, there are some details with the different topics that we do talk about today that are kind of still in the works. So what you just talked about, the employer side of things, that's still in the works, but any amount that the employer does contribute to these Roth accounts are going to be included in the employee's income.
Okay.
And what's really nice is that these employer contributions to the Roth accounts are going to be immediately vested, which is another huge benefit.
That's great.
And vesting, the best way I can describe that is complete ownership. So say you transfer jobs, if you're 100% vested in your account, that means you can just transfer all the funds to your new employer. That's the best way I can describe it.
That's perfect. That's a great way to describe it. That's awesome. So again, that's another huge benefit for employees is it's hard to get a lot of Roth money in the past to save all of that after tax money. So when you are retired, it's completely tax free. But having a matching deposit that's after tax as well is really, really huge.
Yeah, exactly.
And for a lot of people, especially younger people that are starting out, they might have meet only up to the match, and that's what they're going to contribute. So that's again another benefit for them. So pretty cool.
Exactly. I thought that was a good addition.
Yes, absolutely. A lot of good things are happening with Secure Act 2.0. But continuing with the Roth trend, so this is an interesting one. It's high wage earners are going to be required to use the Roth option for catch-up contributions. So essentially what that means is higher earning employees who do catch-up contributions to a 401k, 403b, or other qualified plan are going to be required to use the Roth option, meaning it's going to be after tax and they're not going to get a deduction for that. So it's not going to reduce their adjusted gross income. And typically you're going to be considered highly comp if you make 145,000 or more per year. So if the plan doesn't allow for individuals to make up catch-up contributions to a Roth account, the catch-up contribution rules will not apply to that plan. So that's another interesting one. Any thoughts there?
Yeah, so I mean, like you said, there's a lot of good things in the Secure Act 2.0, but I would say, this specific one probably isn't one of my favorites just because
Yeah, I agree.
It's forcing those higher income earners to pay more tax because they're in a higher bracket for those contributions. So those are kind of my thoughts on that one.
Yeah, exactly. So typically when you're doing a catch-up contribution, that extra 6,500 or 7,000, whatever it is right now, is the ability for you to reduce your taxable income. So especially if you're a higher earner, that's kind of what you're looking for. And that's why you might be maxing out a plan and doing the catch-up is to reduce your taxable income in addition to saving for retirement. So that one's, again, there's always going to be give and take with these sort of changes. I think that one's a little bit of a take, right?
Yeah, I mean, who knows? People may see this new rule and decide they don't want to do the catch-up contribution if they're a higher income earner. So who knows?
Right. So it could disincentivize higher earners to save, but yeah, we'll see. We'll see what happens with it. Next one I got is the 529 to Roth IRA transfers allowed after 15 years. So this is huge in my opinion. So beginning in 2024, individuals can move 529 plan money. So essentially, if you're not a familiar listener, 529 is a college savings account that is tax advantage. So you sometimes get a tax deduction depending on your state for putting this money in. It's tax deferred and it's completely tax-free, used for qualified college expenses. So essentially what is allowed now is if you don't use that 529 money after 15 years, you can move that to a Roth IRA. So there's a couple stipulations here. The Roth IRA receiving the fund must be in the same name of the beneficiary of the 529. 529 plan must have been maintained for 15 years or longer. Any contributions to the 529 plan within the last 5 years are ineligible to move to the Roth IRA. So if you're kind of planning late and saving for college within the last 5 years, those contributions wouldn't count essentially. So the annual limit on how much can be moved from a 529 to a Roth is the IRA contribution limit for the year, less any regular traditional IRA or Roth IRA contributions that are made for the year. So essentially it's pretty much going to be 6,000 per year, right? The maximum amount that can be moved from a 529 plan to a Roth IRA during the individual's lifetime is 35,000. So that's another great opportunity, right? So for people that might not use all of their college funds or decide they don't want to go to college, at least they can still keep some of that money tax-free, right?
Yeah, and if you're young and you decide you don't want to go to college and you have all this 529 money around, then that can just give you a jump start on retirement. So I think this is a really, really good advantage that's been added in, but a lot of conditions do have to be met. I think the most surprising is that the one that surprised me the most was that the maximum lifetime limit was 35,000.
Right. Yeah, that's a good point. So, I mean, with the cost of college, I could see people having much, much more than that in a 529, especially if the people that are helping save for them are really good savers. Typically it's parents, grandparents, things like people like that are saving for their child or grandchild's college. But even say you're 21 and you decide you're never going to go to college, it's super nice to have 35,000 to start in a Roth IRA. It's a really, really big jump start for retirement for sure.
Yeah, and who's to say that 35,000 will increase, over time?
Hopefully it's indexed for inflation and things like that.
Exactly. All right, so next, another new change is that Congress has added in some new options for surviving spouses who are inheriting their spouse's retirement account. So an IRA or a 401k that might be rolled into an IRA, for example.
Mhm.
So all of these new benefits that I'm about to list off do start in 2024. So the first option for a surviving spouse is relating to RMDs. So RMDs, or required minimum distributions, for the surviving spouse can be delayed until the deceased spouse would have reached RMD age. So this is going to be really nice for couples who might have an age gap.
Exactly.
Say the surviving spouse is 70 and the deceased spouse is 60, that surviving spouse wouldn't have to take any RMDs until the deceased spouse would have been 73. The second addition is that when RMDs are necessary, the surviving spouse will be using the uniform lifetime table to calculate the RMD instead of the single lifetime table that applies to beneficiaries. So basically what this means is, since you're going to be using a different lifetime table to calculate that RMD, the RMDs are going to be much smaller, and that's more you get to leave in your account and leave for the next generation. And the third addition is that if the surviving spouse dies before the RMDs begin, the surviving spouse's beneficiaries are treated as though they were the original beneficiaries of the account. So this would allow any eligible designated beneficiaries to stretch distributions over their lifetime, instead of having that 10-year depletion rule. So I think that this is a great benefit. I really like how they're making changes to the RMDs and having that delayed, and it's just going to save the surviving spouse a lot of money.
Absolutely, and especially if they're financially dependent on the other spouse's accounts and things like that. I think it could be really, really helpful for retirees and people that are dependent on those accounts. So I think that's a huge one. Again, there's a lot of good things coming out of this Secure Act 2.0. Any other thoughts on that? I think it's a great one.
Yeah, that was pretty straightforward. I like everything that's been added regarding that topic. So moving on to the next topic, it involves catch-up contributions that are now going to be indexed for inflation. So back in 2001, that is when IRA catch-up contributions were created. And around that time, the catch-up contribution limit was a flat amount of $500 per year, and it wasn't indexed for inflation. So it wasn't until 2006 that the Pension Protection Act actually doubled the original IRA catch-up contribution limit to a flat amount of $1,000, but it still wasn't indexed for inflation, and it hasn't been changed since then. So it's been nearly 15 years since
this limit has been
updated. So starting in 2024, the new IRA catch-up limit will automatically adjust for inflation. So the inflation adjustments are going to be made in increments of $100. So by 2024, the new limit is going to be about $1,200.
Great, that's great.
And something that's really interesting is that, prior to the Secure Act 2.0, the IRA catch-up contribution limit was the only annual retirement limit that was not automatically indexed for inflation.
That's funny. It kind of just got forgotten somehow. But for a lot of people, that's their main source of savings, especially if they don't have a employer-sponsored plan, or they're self-employed or something like that. That's pretty crazy. So I think that was a really necessary one, because being able to, when you're 50 plus, $7,000 a year of savings isn't really that much in the grand scheme of things. So it'll be nice for that to continue to increase over time. So I think that's a really, really good benefit that they probably needed to tackle 15 years ago, right?
Yeah, I was gonna say, I'm surprised they didn't do that a lot sooner.
Right,
Every other account does it, so I
right.
thought that
Yeah,
was
catch up
interesting.
for qualified plans, the catch up is increased over time. So it's really
Mhm.
interesting. It hasn't. Okay. I got a good one here. So, there is an increased planned catch-up contributions for participants in their early 60s. So these are kind of a couple one-off years that you can make extra catch-up contributions. So under the current law, individuals who are 50 or older at the end of the calendar year can make an additional catch-up contribution to retirement accounts on top of the annual limit. So for example, for a 401k, you can contribute 22,500 in 2023. If you are age 50 or older, you can also contribute an additional $7,500 in 2023 for a total of 30,000, right? So that's the current law. What's happening in the future is going to be individuals who participate in a qualified plan, 401k or 403b, and who are only the ages 60, 61, 62, and 63 will have their plan catch-up contribution limits increase to the greater of 10,000 or 150% of the regular catch-up contributions starting in 2024. So essentially, they're making it 10,000 now, or they're indexing it for
Mhm.
inflation as well, right? So similarly, for simple plans, participants who are the same age ranges 60, 61, 62, 63, catch-up contribution limits increase to the greater of 5,000 or 150% of the regular simple catch-up contribution. So um, there's an example here. So the greater of 10,000 or 150,000, 150% of the future regular catch-up contributions. So when 150% of the 2023 catch-up contribution is already going to be over 10,000, 75,000, 7,500, excuse me, times 150% is 11,250. So essentially, as of 2023, those people in that early 60s can contribute an additional 11,250, which is nice. So I think this is really helpful for people that are really narrowing in on retirement. So a lot of people think is retirement age is 65. So I think this is just giving them an opportunity to save a little bit extra those last 4 or 5 years, right?
Yeah,
So
and I think a lot of people will probably take advantage of this. Because like you
absolutely.
said, retirement age, I would say on average is around age 65. And those last few years are crucial for some people. And so
Mhm.
I think this is definitely going to be taken advantage of.
Right. Yeah. But a lot of people, these are their kind of their late 50s, early 60s. They're going to be in their highest earning years. They're going to want to save as much as possible on taxes if possible. Right. I know there's new rules with if they're highly comped for the Roth option now that they have to save those catch up contributions too. But say you're not highly comped or you're on the threshold, it's a good way to sock away a bunch of money, shelter some taxes, and
Mhm.
it's a great benefit. I like that. I think people, a lot of people, kind of make a mistake and start saving late. So this is a way for
Mhm.
them to really save a lot towards the end of their working career.
Yep, I agree.
All right. Next one I have for you is going to be new rules for qualified charitable distributions or QCDs. So essentially, a QCD is donating right out of a retirement account to offset your required minimum distributions each year. And under the current law, individuals who are 70 and a half years old are able to donate up to 100,000 to one or more qualified charities. With the Secure Act 2.0, beginning in 2024, the QCD limit will change for the first time, and it again will be linked to inflation. So beginning in 2023, taxpayers may take advantage of, also, I should say, beginning in 2023, taxpayers may take advantage of a one-time opportunity to use A QCD to fund charitable remainder unit trusts or CRUT, and charitable remainder annuity trust, which is also called CRAT, and charitable gift annuities, I should say. So those are just some estate planning accounts for people that want to leave money to charities after they pass. So essentially, you're getting some more flexibility there. A little bit more information. The maximum amount that can be moved in this once in a lifetime distribution is $50,000. Again, this is going to be adjusted for inflation, which is nice. So it would be hard to imagine a scenario where it would be worth the taxpayers' time and expense to set up a CRUT or a CRAT for only $50,000. So that's a good point. Those are fairly expensive and time intensive to set up. So most people that are doing that, it's for a pretty serious estate to help shelter some estate taxes. But again, it's a little bit extra that you could convert to that, right?
Yeah.
A couple other points here. Distribution to a CRUT or CRAT will only count as a QCD if such trust is funded exclusively by the QCD. Okay. And further limitations say that there are only income beneficiaries of such qualifying CRUT or CRAT can be the IRA owner and their spouse. So essentially, CRUTs and CRATs, just to give listeners a really brief overview, charitable remainder means you're going to get income or an annuity stream over your life or the beneficiary's life. And then once you both pass on, that money is going to go to charity. And it's a little bit complicated. And if you have questions, it's a great topic for an estate planning attorney.
Yeah, and I liked this new addition, but these charitable trusts are typically for higher net worth individuals.
Right.
And some of these limitations I'm not a huge fan of. I think it makes everything a little bit more difficult. So I don't know how much of these types of transfers, we'll see.
Yeah, I think it'd be rare, in my opinion, but it's a little bit extra. My biggest takeaway is QCDs are going to be indexed for inflation in this part, right? So I think that's huge.
All right. Any other thoughts before we move on to the next topic?
No, I'm ready.
All right. So this next topic, it's going to be kind of a long one. So there are some new rules for accessing retirement funds and avoiding the 10% early withdrawal penalty. So I know I've talked about this a little bit before, but I'll just reiterate. Currently, there is a 10% early withdrawal penalty from retirement accounts. So an IRA, for example, if you withdraw funds before you're 59 and a half. Now, there are some exceptions to that, and that can include if you need money for higher education expenses, deductible medical expenses, death or disability. So that 10% penalty is still in place, but Congress is just expanding their list of exceptions. So I am just going to kind of go through this list. So it starts off, the 10% penalty exceptions are if you work as a private sector firefighter and you are age 50 and older and separated from service. If you work as a state or local corrections officer or other forensic security employee and you are age 50 and older and separated from service. Adding on to that, if you're separated from service before you reach age 50, but you've performed 25 or more years of service for the employer sponsoring plan, that is also considered exempt for this penalty. And for that last point I made, the 25 years of service does have to come from one employer. It can't be split up between 2 or 3.
Wow.
So still going down some of these additions. The next one is that Congress has permanently reinstated what's called a qualified disaster recovery distribution. So this means if your primary residence is within a federally declared disaster zone, you can take a distribution within 180 days of the disaster. But the maximum dollar amount that you can take for that distribution is $22,000. So kind of, again, going off this qualified disaster recovery distribution, there were also changes to being able to take loans out for any kind of disaster. So you can also take loans from any qualified plans of up to 100% of your vested balance, and normally the limit is the greater of $10,000 or 50% of the vested balance. And the maximum loan you can take now is $100,000. So it's a pretty big difference.
Yeah, that's a big
dollar-wise.
change there.
Yeah, because the greater of 10,000 or 50%, which was previously the rule,
Right.
up to a max of 100,000. It's a pretty big deal. So continuing on with some more exceptions, the terminally ill exception was also expanded from having 24 months to live to having 84 months or 7 years to live. All distributions must be repaid within 3 years. So going from 24 to 84 months, that's a pretty big expansion to the 10% penalty exception. Now, this next exception, which is pretty interesting, relates to domestic abuse victims. So this starts in 2024 or later. They're not 100% sure, but it authorizes victims of domestic abuse to withdraw up to the lesser of $10,000 or 50% of their vested account balance without incurring that 10% early withdrawal penalty. So any distributions made from a defined contribution plan within 1 year period after that individual has become a victim of domestic abuse, and all or a portion of that distribution must be repaid within 3 years. So when I read that rule, I didn't see too much additional information.
Right.
So I'm sure they're still kind of working through the weeds on that one. But I thought that was really interesting. I wasn't expecting to see, something like that in this new bill, but I think it's great.
It's great to expand reasons why, if people really do need access to money, especially in a terrible circumstance like that, if they need to move or do something like that, I think that's huge for people. So it's another great addition to Secure Act 2.0. Again, I know there's been some give and some take, and I think that one is great.
Yes, I agree. All right, so the next exception is regarding emergency withdrawals from retirement accounts, and this begins in 2024. So taxpayers who experience unforeseeable or immediate financial needs that relate to necessary personal or family emergency expenses. The limit is 1 distribution per calendar year at a maximum of $1,000. And if there is, more than 1 emergency withdrawal, that can be taken until the earlier of the following. And that includes prior distributions having to be fully repaid, or regular deferrals and other employee contributions made to the plan, since the emergency withdrawal total at least as much of the amount of the distribution, or 3 years have passed since the previous emergency withdrawal. So just whichever one of the earliest those 3 happen is when you could take subsequent emergency withdrawals again. Again, not too many details regarding this topic. I'm sure Congress is still working out all of the details, but that starts in 2024. All right, so continuing on with the list of exceptions, we're almost done. We just have a couple more. So this one starts in 2026, and it allows retirement account owners to take a penalty-free qualified long-term care distribution. And that is for the lesser of 10% of their vested balance or $2,500 annually to pay for that long-term care insurance. But the long-term care insurance premiums must be equal to or greater than their distribution in the year that the distribution is made. And you also have to provide your plan with a long-term care premium statement, just kind of detailing some information. And the last exception to this 10% penalty is for annuity payments, and those annuity payments can now meet 72T distribution requirements, and that starts immediately. So you can make partial transfers or rollovers to other accounts as well, and that was previously disallowed. So
Right.
a lot
Yeah.
of new,
exceptions.
Yeah, quite a bit.
So yeah, I think a lot of those are really great. It's good that if people are in a bind to avoid that 10% penalty. Really, in my world, this is just if people think of hardship withdrawals that avoid the 10% penalty, this is what those are expanding. So that's great. I really like the annuity payments for the 72T distribution. So what a 72T rule or clause is, essentially, if you take substantial equal payments, you have the ability to access retirement money, 401ks, IRAs before 59 and a half, right? So for a lot of people, say they retire at 54 or 55, they can take substantially equal payments, which is usually has been a pretty rigid rule until either 5 years or they turn 59 and a half. So it's a really great way for people that they've saved really hard and have a bunch of money in 401k, they want to retire early, they have the ability to do that. But annuity payments now meet that as well, which is great. So also nice, you can make partial transfers and rollovers. So in addition to all the exceptions, I think I really like the relaxation of the 72T rule. That's a big one.
Yeah, I do too. That was definitely one of my favorites as well. And then just adding on to I like the qualified disaster and expanding some of those limits. The emergency withdrawals, I wish the maximum was a little higher than 1,000, but maybe that's something that will change over time. But it's a good start.
So, yeah, absolutely. It's just giving plans more flexibility for participants, which is great because a lot of people, their retirement savings can unfortunately be a backup if they don't have adequate savings. So it's good to give them a little bit more access to that, in my opinion. Again, don't recommend it for clients, but if it's an emergency, you can certainly use it, right? All right. Next topic I have is the creation of linked emergency savings accounts. So with the Secure Act 2.0, effective in 2024, individuals who participate in an employer retirement plan may be able to link an emergency savings account to their employer plan, and such accounts will not be available as a standalone individual account. So essentially what I'm kind of getting out of that is it's kind of like a backup emergency account that's tied to your 401k or 403b, whatever it may be. So I think that's nice that kind of gives people a way to save, not have to tap into their true retirement funds as well, right? So I think it helps people avoid those hardship withdrawals and helps people avoid that 10% penalty, which is good. So there's a little bit more information here about it. So you can't be highly compensated to be eligible for this benefit. And you can't own 5% more of the business. So it's kind of those highly compensated key person rules. and you can't receive more than 135 in compensation in the previous year for 2023, and you are not in the 20% of the compensation at the employer. Eligible employees' contributions must cease once the balance in the account attributable to contributions reaches 2,500. So I think that's kind of where you were saying $1,000 is kind of small for emergency withdrawals. Maybe in a plan structured like this, 2,500 is a little bit better. So I think that's a cool idea, and I think a lot of people do tap into their retirement accounts too early. So if you can kind of gently force people to save 2,500 bucks, that's an emergency fund, I think that's really great.
I do too. I just wonder,
How
how
often it's
everything's gonna, yeah, how is everything gonna work out? How it's, gonna be put in place, utilized, just things like that we still are waiting on some more information. to be
Right. Yeah.
released.
So what's funny is that we're still waiting on clarity from Secure Act 1.0, right? We still don't have full clarity there on RMDs and all that stuff yet, but especially with the 10-year withdrawal window. But again, it's nice to see a lot of these changes are aiming at helping people, which is good. Okay. There is a new kind of expansion to ABLE accounts. So essentially an ABLE account is for disabled people and their family members. So under the current law, ABLE accounts may only be established for individuals who become disabled prior to turning age 26. Okay. ABLE accounts are essentially a tax advantage savings account for individuals with disabilities and their families. So again, for people that are disabled, they may not be able to work and have earned income, so they couldn't necessarily contribute to a Roth IRA or something like that. This is an account that kind of accomplishes that for people. So effective with the Secure Act 2.0 for 2026, ABLE accounts can be established for individuals who become disabled prior to age 46. So that's a 20-year difference, which is huge. So you don't have to be under age 46. You must only have been under age 46 at the time you become disabled. So I think that's great. What are your thoughts on it? It's nice to give people expanded options.
Yeah, no, this was one of my favorite additions as well, because the article where we got a lot of this information from was from Michael Kites, and he kind of pointed out that a lot of conditions, medical conditions, mental health conditions may develop or happen before you are 26. So by adding that 20 years, it's really going to include a lot more people for this kind of benefit.
Yeah, that's a great point. It's great.
All right, so moving on to our next point, it's gonna relate to qualified first responders. So it can include law enforcement, firefighters, and EMTs. So currently, if you are a disabled first respondent and you receive a disability pension or an annuity that relates to your service, generally those amounts are excludable from income. But once these first responders reach their regular retirement age, their disability pension becomes a retirement pension and it's no longer excluded from income. Now, the Secure Act 2.0 has made changes starting in 2027, where individuals can carry on that tax favored disability payment through their lifetime. So whatever those nominal amounts for that qualifying first responder were that they received as a tax-free payment prior to their retirement age, they can continue to receive as a tax-free payment after their retirement age.
That's great. Yeah, that's great, especially if these people were injured and they are receiving some sort of disability pension. I think it's great to continue the tax-free status of that. So I think that's huge for a lot of people.
Yeah, it's going to be extremely, extremely helpful. So our next edition in the Secure Act 2.0 involves sole proprietors and LLCs. So under current law, taxpayers have been able to create and fund certain SEP IRA accounts after the end of the year for the previous year. So for example, a SEP IRA that was maybe created in June of 2022 could receive contributions for 2021, even though no plan actually existed as of 2021. But under the new act, sole proprietors and single member LLCs can establish and fund solo 401k plans with deferrals from the previous tax year up to the due date of the individual's tax return. So basically, this is just allowing you to contribute as a prior year contribution, whereas that wasn't allowed before.
Right. So essentially, if you're filing in April, or you would have the ability to fund that all the way up until April of the following year, right?
Yeah, and I know a lot of people do make prior year contributions. So I think this is going to be a popular one.
Yeah, and it's helpful for people that most people don't know exactly what their tax liability or situation is until through the end of the year. So if they have an idea, can incentivize them to make a prior year contribution. So I'm all for incentivizing people to make retirement contributions and giving them expanded flexibility. So again, I think it's another great one. Any other thoughts on that topic?
Nope, that one was pretty straightforward for the most part.
Right. We're getting closer to the finish line here. There's a ton of information on the Secure Act 2.0. So listeners, this is a longer one, but we're going to continue to dig through it here. Next topic is going to be new relief for retirement account mistakes. So typically each year, retirees that are above 72 or 73 have that required minimum distribution. So there is going to be a reduction in the 50% penalty for missing an RMD before the end of the year. So starting in 2023, the 50% penalty for an RMD is reduced to 25%. However, if the shortfall is rectified within the correction window, the penalty is reduced all the way to only 10%. So the correction window begins generally on January 1st of the year following the year of the missed RMD, and it ends upon the earliest of the following dates, which is the notice of deficiency is mailed to the taxpayer, when the tax is assessed by the IRS, or the last day of the second tax year the tax is imposed. Okay, so there's a statute of limitations for missed RMDs now, and most excess contributions to be tied to Form 1040. Previously, penalties were reported on Form 5329. The problem was if you didn't realize you missed an RMD or went over the annual limit in contributions, the form was not filed, right? So now penalties will be filed on Form 1040. If an individual is not required to file Form 1040, the statute of limitations or clock for those penalties will begin ticking upon the tax filing deadline. So again, if something like this does happen, obviously you want to speak with your accountant, right? Finally, we got two more topics: expansion of the employer plans compliance resolution system to address IRA-related issues, and finally, confirmation/clarification that IRA prohibited transactions only disqualify the involved account. So those are a little bit more complicated informations, but I think the big takeaway is the reduction of the RMD penalty, right? Because a 50% penalty, in my opinion, is just crazy. So 25 is still high. 10% is better. So I think if people get that corrected quickly, that's great. So I think that's a really, really good thing to ease those penalties a little bit.
Yeah, it doesn't tax the individual nearly as much.
Right. And a lot of people, older people may just forget or get confused, and they don't have an advisor that they're working with helping them do that, they may just not know, right? So
Right.
not be intentional. It's just an error, and 50% was kind of ridiculous in my opinion.
Yeah, and I'm sure that happens a lot too, regarding the missed forms. If you have an elderly person who doesn't even know they missed an RMD, well, then they don't even file the form. So it's nice that there are benefits now to both sides of that.
Absolutely. Okay. Next topic is going to be annuity related changes. So, first topic is qualified longevity annuity contracts, or QLACs as they're commonly known. QLAC is an investment vehicle that allows funds in a qualified retirement plan, such as a 401k or 403b or an IRA, to be converted to an annuity. So essentially, you have a 401k, it's the ability to have an annuity in that 401k, essentially. So the current law, the maximum amount that can be used to purchase an annuity with a 401k or an IRA is $155,000 for 2023. Now with the Secure Act 2.0, the maximum amount is going to go up to $200,000. So a little bit of a change there, kind of nice for people that do want guaranteed income or an annuity with these retirement plans, right? A couple other topics regarding this: income annuities held with qualified accounts, so you can do that now, and expansion of eligible investments for variable annuities and variable universal life policies. So it seems like most of these regulatory changes, there's always a few expansions of annuities, so it's for people that do like that stuff. It's there. Okay.
Yeah. So yeah, I think that's a great addition as well. I don't know how much, I don't really deal too much with QLACs. But it's nice that they raise that maximum amount. All right, so going on to our last topic, it's just kind of a group of random things that were added into this bill. So I'm just going to go down the list. And so the first one, it begins in 2024. And employers will be able to amend their plans to allow employer matches to go towards student debt that is paid by plan participants. So I think that is a great benefit to employees and a great option. And I'm glad that was added into this bill.
Yeah. Especially with the amount of student debt that's out there now, a lot of people, they can't afford to contribute to a retirement account because they're servicing that debt. So they might be missing out on that matching contribution. So I think that's really huge, that if people are paying down their debt, it's nice that they can still get that match towards their retirement plans.
Yeah. And it's nice that it's not coming out of your salary. You get a little bit from your employer. All right, so the next edition, it begins in 2025. And many new 401k and 403b plans are going to be required to include auto enrollment. Now, there is a list of exempt employers, and the list is kind of long, but it includes employers that are less than 3 years old, church plans, government plans, simple plans, and employers with 10 or fewer employees. So this is really going to impact employers with more than 10 employees.
Right.
So, think 401k, 403bs. But I think this is really great because I know a lot of people probably do not enroll in these plans. So to have that automatically done, I think is amazing.
Absolutely. I agree.
All right. So this next rule begins this year. And employers with 50 or fewer employees, the retirement plan startup credit is now going to be allowed up to 100% of plan startup costs, and the previous limit was 50%. So this is a nice benefit for employers, and this is going to be for smaller businesses.
Right. Yeah, that's great for small businesses. That a lot of the reasons small businesses may not offer a retirement plan is because there's a pretty significant cost associated with starting the plan, the annual record keeping, and compliance that goes around all of it. So it's nice that if they can write off all of those startup costs, I think it's going to incentivize people to start these plans, right?
Yeah, we'll hopefully see a lot more people saving for retirement.
Absolutely.
All right, so the next item is also effective this year. And it's for employers who offer non-highly compensated military spouses special plan benefits. They are now eligible for an additional credit of up to $500 for each military spouse for up to 3 years per spouse.
Great.
The next one is effective in 2024, and employers with simple plans are going to be able to make additional non-elective contributions to plans up to the lesser of 10% of an employee's compensation, or $5,000. I think this is great because I do know simple plans typically have, lower contribution limits
Right, yeah.
compared to a 401k or 403b. So it's nice that they're getting a little bit of a boost.
Absolutely. Yeah. So most simple plans, it's typically 2 to 3%, either safe harbor contribution or match, typically is what we see. So it's nice to see that expanded.
Yeah, and the next point is, again, kind of relating to simple plans. So starting in 2024, simple IRA contribution limits for some simple plans will increase, not all, but specifically for employers with 50 or fewer employees, the deferral and catch-up contributions will be increased by 10%. And employers with between 51 and 100 employees can give employees the same enhanced deferral limits if they increase their matching contribution to 4% and their non-elective contributions to 3%. So those matching contributions will increase for some employers next year too.
Right. That's great.
All right, and the last change that we're going to go over, this starts in 2024. And it's actually a new type of employer-sponsored retirement plan. So it's called the Starter 401k plan. And it's going to be an option for small businesses. And again, there's going to be auto enrollment, but no employer match. And the contribution limits are going to be similar to IRA, so around 6,000, 6,500.
Cool.
So we don't have
neat.
details on that one yet, but that will be
Right.
interesting when it comes out and we get some more information. I think that could be a good one as well.
Absolutely. Yeah. A lot of these changes aren't for a couple years, or even more than
Yeah.
that. So, but that's a great one. So if people aren't really willing to take the initiative to open an IRA and fund it each year, having that starter 401k that's probably cheap and easy to set up for an employer sponsored plan. Even though there's no match, I think with the auto enrollment, it's just going to start forcing people to save without them realizing, which is a good thing in my opinion, right? So
Yes.
when there's auto enrollment, people can always opt out, so it's not forced. But most people, they don't think about it; they'll contribute kind of the minimum that's required, and I think that's a great thing. Okay, so. I know that was a lot of information for the listeners. Again, the Secure Act was 2.0 was a massive document with massive amounts of changes. I know we only covered some of it. There's even more to be covered, but I think we covered a really good amount of the kind of what could impact the average person or majority of people. I just kind of wanted to highlight my top 4 or 5 takeaways from this Secure Act 2.0. So my biggest ones were further delaying RMDs and the expanded Roth options. So all of the different Roth changes that are happening, the elimination of RMDs, simple and SEP Roths, Roth matching contributions by employers, the 529 to Roth transfer, and the highly compensated Roth catch-up requirement going forward. And the last two was catch-up contributions for IRAs indexed for inflation. And the last big one that I thought of was the special qualified plan catch-up for those early 60-year-old people. So those were my biggest takeaways. Obviously, there's a lot of good changes happening in the Secure Act 2.0. So any final thoughts before we kind of leave it there?
No, I mean, I agree with you. I think everything that came out for the most part was pretty beneficial to
Absolutely.
everybody. It's kind of nice that all these changes aren't happening all at once. Because that would
Yeah, especially
be
for you and I, right?
yeah. So it's good that it's kind of spread out and it gives individuals, the chance to learn or plan for these changes.
Absolutely. Yeah. So again, just kind of wanted to reiterate that disclosure again. If they do have questions around these changes and taxes, that's a great question for an accountant going forward. But I appreciate listeners listening to this long one here. Again, if you have questions, reach out. But the Secure Act 2.0, it's I would say overall, it's a really great thing for retirees and savers going forward.
It is.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.